Hey YouTube, Jaron Gledhill here. Today we're going to be talking about the basics of investing. So what is it investing exactly? In his book Rich Dad Poor Dad, Robert Kiyosaki teaches that you have to make your money work for you. So what does that mean exactly? Well, let's create a little equation here. When you get paid at the end of a workday, you get paid your wage multiplied by the number of hours worked. So if you work 10 hours and you make $10 an hour, you made $100. If you make $100 an hour and you work 10 hours, you just made $1,000. So in this equation, there are these two pieces, two inputs, and there's an output, how much you get paid. So how can we change this equation? Robert Kiyosaki suggests that we add assets to the equation. An asset is anything that adds cash flow to your portfolio. So now instead of just working for money, you take some of the money you made after the first day and you purchase something that can make you more money the second day. And then you take some of that money and continue to reinvest in these assets that increase your cash flow. They have said that compound interest is the eighth wonder of the world. And if you haven't, I challenge you to open a Google Sheets or an Excel spreadsheet and start out with any dollar amount you choose. Maybe you put in exactly what's in your bank account right now. And then in each row of the Excel spreadsheet, I want you to multiply it by 1 plus, let's use 10%. That's kind of like a ballpark figure for what the S&P 500 returns. If you multiply it by that amount and then adjust it each row to reflect the new balance, you will be amazed at how quickly the amount that's in your account or that's in this hypothetical portfolio will just exponentially increase. And that's the power of investing. So what are some of the assets we can buy? Well, there's stocks, which is like buying a part of a company. There's bonds, which is like basically loaning money to the government. There's mutual funds, which that's when they basically purchase stocks for you in a group, and then you give them an advisory fee. There's index funds, which has a group of stocks, and then you pay them a very low advisory fee. You can buy a rental property if you have the capital for it. You can buy an entire business. You can buy cryptocurrency. You can buy a fleet of rental vehicles. You can buy commodities such as gold or silver. All of these things have different ways of earning money, quote unquote. A stock might pay dividends. Bonds will pay you the coupon value. The mutual funds, that's more in the terms of unrealized gains, although some mutual funds will also pay you dividends. A rental property, obviously you get paid in rent. Businesses, you'll be paid in whatever profit is left over. If you buy cryptocurrency, you're kind of counting on that going up in value. And then rental vehicles, you're going to rent those out to someone, they pay you that rent money. Gold and silver, same thing as crypto, you're kind of counting on that value to go up. And most things do go up year over year. So these are the assets we can buy, and they can change this equation that we talked about earlier and can change the output of how much money you make. Because now, instead of just being how many hours you worked times your wage equals how much money you make, it's how many hours you worked times your wage plus however much money your assets are making. So now you might say, well, which is the best asset? That is what every finance guru in the world is trying to kind of push on their followers. Some will say, no, crypto is the way to go. Others will say, just buy the S&P 500 and never buy anything else. Others will say, you got to do real estate. You got to buy rental properties. And a more balanced approach might be to buy a little bit of everything. In fact, many finance gurus understand that if you diversify the assets that you purchase, you can actually kind of mitigate some of the risks associated with them. So for example, let's say that two people start investing, and one person puts $1,000 in the S&P 500, which is basically a basket of the 500 largest companies in the world. And the other person takes that $1,000 and invests in Facebook. Now, sometime last year, Facebook took a dive. They lost an incredible amount of stock value. So if they were both investing last year, the person who invested all of their money in Facebook would be devastated. Maybe in the long run, they'd be able to compete with the S&P 500. But the person who was able to diversify and who, kind of hedged that risk, didn't experience that massive downturn because they owned, in addition to Facebook, they owned 499 other companies. So diversification prevents us from putting all of our eggs in one basket, and then just like Humpty Dumpty, your portfolio could come crashing down if it's all in one asset. Now, I'd like to liken compound interest to if you're racing another car. So someone who has their money invested, letting compound interest do its work, their earnings might be slower than if you were to just go make money right now. But compound interest it accelerates slowly, but the top speed is incredibly high. And once again, I urge you to kind of follow that through on a spreadsheet so you can see the actual numbers, play around with them, because it's huge. I mean, $1 that you invest today ends up being like $150 when you retire. And, if you invest $1,000, it's going to be $15,000. And these numbers really accelerate very quickly the more you invest, and depending on your age. So with investing, you want to buy these things that give you this cash flow. And the other thing that we're expecting is that we want to purchase these for a low price or a low cost basis, and we want to sell them later down the road for higher than we purchased them. Now, you might wait till retirement to sell them, which is probably the best from a tax perspective, or you might have sort of like a way to slowly sell things off as you go, and that's a way to sort of mitigate some of that risk that you sell at the wrong time. Same thing applies to when you're purchasing an asset. If you slowly buy in small amounts, you can spread out that risk. And then with investing, there's long-term gains and capital gains when you sell. And so with long-term gains, you're going to be paying usually a lower rate, and the short-term capital gains will just be taxed at your ordinary income tax rate. So you got to be strategic about that. But the main takeaway from this video is to look at where your money is now, assess your portfolio. And then what you need to do is get some of that money and put it into an asset that will start making you money. And this is incredibly important in the long run, because over 30, 40 years, you'll soon realize that the amount of time you have to make money is running out. And so you need to leverage your assets, leverage your money as much as possible so that you can comfortably retire and so that you can live off of that cash flow. I hope you enjoyed the video. Please like and subscribe. Leave a comment down below, and feel free to ask any questions down there or share your own experiences with investing. If you think a certain asset type is better than the rest, please put that down in the comments. Thank you for watching.